And you might be thinking, what do you expect is going to happen? Is there going to be a surge in inflation? Is war going to break out? Is there going to be a market crash? Hi, I'm Chris, and in this video, I'm going to be sharing why I think January is the most dangerous month for investors. And you might be thinking, what do you expect is going to happen? Is there going to be a surge in inflation? Is war going to break out? Is there going to be a market crash? And in fact, none of these things are why I think January is the most dangerous month. The reason is twofold. So in January, you see a huge amount of media that covers two topics in finance. First of them is predictions. We see a whole bunch of market commentators come out with their predictions, which asset classes they think are going to do well, which markets, what's not going to go well, what the economy is going to do. What we know from these predictions is that most of them turn out not to be correct. And in fact, if most of these professionals had their predictions measured, we'd see that there was really just random chance whether they get it right or not. Your danger as an investor is paying attention to any of these predictions, because what it can do is send you off course with your investing goals and investing strategy. And this is why January is dangerous, because we see a lot of these in the news. Every commentator's out there, every fund manager is out there trying to drum up interest in the ideas, but ultimately most of these ideas don't come into fruition. You know, that's why the SPIVA S&P study year after year shows only about 20% of fund managers actually beat the market after fees over any sort of reasonable period. So what you need to do is block out these stories or read them as entertainment, but appreciate that none of them are actually worth incorporating into your investing decisions. The second reason I think January is dangerous is because active fund managers are out there explaining why this year they believe active management is going to work. And this is also dangerous, because if you fall for this trap and suddenly decide in January it's a time to move your money into actively invested strategies, that is unfortunately what's going to likely be your undoing this year. And we see this every year in January. Fund managers come out there and say, because of the uncertainty, and that's the word I see over and over again, it's time to use active management. The reality is, every year is uncertain. That's the reason why most active fund managers do poorly, is because the future is unknowable. The future is uncertain. In fact, when you're investing in the share market or any sort of risk asset for that matter, the reason you earn a higher return than leaving your money in the bank is the uncertainty. The uncertainty that you don't know what returns are going to be over 1 month or 6 months or even a year. That's actually what you're getting rewarded for. So you need to embrace the uncertainty rather than switch your investing strategy, because every year there are surprises. There are economic surprises, political surprises. If it's not a surprise, then it probably doesn't impact the price. And anything that isn't a surprise is probably already embodied in the price. So my recommendation is, in January, as much as it's tempting to get caught up in predictions and get caught up in the temptation to move your money into an actively managed strategy, your biggest danger in this year isn't the market movements, it are these temptations in January. And if you can stay true to your disciplined, low-cost, diversified, passive strategy in January, you have actually overcome the biggest danger of the year, and you can then get off and enjoy your life and be hands-off with your investments and know that your investments are going to sensibly grow over the long term without any of these traps this year.